First up this evening, Kokkie Kooyman, Head of Sanlam Investment Management Global, who's joining us from our Cape Town studio. Thanks so much for your time, Kokkie. As I said, Kevin is in studio. He's ready and firing with questions, but perhaps I can get in there first. Earlier we were chatting off air and you were saying that you could buy any banking stock right now and you could make money. Do you want to stand by that statement?
Yeah, well, any is obviously quite a wide statement, but most. And what's happened globally is with the fear of the European collapse and the Spanish and Portuguese and Greek property prices, and also the Irish economy, and at the same time the whole US problem, there's been just such a fear about banking shares, and they've been pushed down totally unreasonably. So there are quite a number of nice opportunities. You've still got to be circumspect, but I think if for the investor who thinks 2, 3, 4, 5 years, you can double your returns.
Kokkie, would you still be looking at, or would you be looking at banks within the euro, within Spain, within Italy, within Greece?
Yeah. We don't, and the simple reason is, and it's not really only us, it's any investor should look at investments that way. It's all about certainty. So you've got the risk, certainty, and your valuation triangle, and valuations seem quite attractive in Europe. But your problem in Europe is just there is huge uncertainty still about, let's just take Spain at the moment. The property prices haven't adjusted adequately, we think, yet. There is significant amount of property that is just standing idle, that is just standing empty, that has to be sold, and the banks really haven't written that down. So you've got one problem in that the assets on the balance sheet are still mispriced. And then a second problem, there are huge sovereign debt exposure still to Spanish government bonds, which at the moment are repricing in the wrong way. Which could lead to the Spanish and the Portuguese and possibly the Italian banks needing more capital. So, you look at a bank, let's say, that's trading at a 50% discount, but after you've written off the bad assets and you've recapitalized it, maybe the discount's only 10%. So what we've been doing, we've been spending a lot of time rather on the UK banks. Barclays is one, Bank of Ireland. I was just in Ireland, I think, last week. And what in those two economies, you haven't had the same excess in terms of property, well, the UK, and in Ireland, most of the property problems have been solved on the bank balance sheet by just taking them off the bank balance sheet.
Kokkie, can I just clarify?
The properties to the Irish government.
Can I just clarify there? Would you be buying the Bank of Ireland?
Are better, and you've been recapitalized in both cases, and so you haven't got that risk of your net asset value disappearing. So,
Kokkie, I just want to pause there for a moment. I just want to clarify that you then would be buying the Bank of Ireland. Are we having an audio problem there? It appears we are. This is live television, ladies and gentlemen. There we've got Kokkie Kooyman back online. Kokkie, I was saying there, and I was trying to interrupt you earlier, and I thought you might not be able to hear me. Would you be buying the Bank of Ireland after that visit to Ireland, as you were saying?
I'm very tempted. The big problem in a global universe, there are so many other temptations as well. But Bank of Ireland, if you just think simply, it's trading at, let's say, 0.3, 0.4 price to net asset value. That's a discount of 60%. In 5 years' time, it should be trading at double that rating. It should trade at 0.8, which is still a 20% discount to the net asset value. So that means you're going to double your money in 5 years' time. That's 20% per year. It's just a very good return. But the problem is you don't know when the re-rating is going to occur. So you could maybe wait for 2 years while everybody's worried about Ireland, and then suddenly in 1 year it takes off. But everything is in place. Bank of Ireland is safe, it's sound, it's recapitalized, the assets are okay. So Bank of Ireland is a sleeper that you should put in your portfolio, and one day you wake up and it's doubled.
Kokkie, if I look at the top holdings within your fund, you're talking about looking at the UK, you've gone to Ireland, but if I look at the top holdings, there's quite a lot of emerging market banks.
Yeah. okay, this is the fascinating part. In what we try and do in the portfolio, we have most of our shares and the larger holdings in companies that generate a very high return on capital. Now, what I didn't say about the Bank of Ireland just now, and the same at the moment goes for Barclays and Lloyds, TSB and Royal Bank of Scotland, the return on their capital is at the moment still 4, 5, 6%. So that's a very low return, which means your capital grows by 6%. But think of a savings account. So your savings account grows by 6%, whereas your emerging market banks, the return on the capital on average is still 20%. So your capital is growing at 20%, a much higher rate. So at the moment, we still prefer that certainty of the higher returns on those banks that we know fairly well and are also attractively priced. And coming back then to Bronwyn's question of Bank of Ireland, so what we're doing on companies like Barclays and Bank of Ireland, every now and then you get a shakeout like you had actually this week, where the share prices fall 10, 20%, and then we step in and we buy. We've been buying Barclays earlier, well, in fact, yesterday still at 210. Barclays a few weeks ago was trading at 250, it's now 210. We know it's cheap, so at 210 we'll buy some. But it will still be a small part of the portfolio while there is still uncertainty.
Kokkie, can I just interrupt you there? Can you put in that discussion, can you put the South African banks into that context?
Yeah.
You still don't own South African banks in your portfolio.
You knew the question was coming, Kokkie.
And can I ask you, please,
Yeah.
it's a bit unfair, but can I ask you just to comment on Capitec? I mean, you'd obviously know the bank reasonably well. Is it something that you'd be concerned about in terms of the growth in unsecured credit domestically?
Ooh, okay,
I didn't see that one coming. He's ambushing you. He's ambushing you in studio. You're not allowed back into the studio.
Banks, relative to international banks, Barclays trading at 0.5, that's a 50% discount to its let's say audited net asset value. Or audited doesn't mean that much often today, but whereas let's say Standard Bank is trading at 1.6, so it's a 60% premium, and First National, First Rand trades at 1.9, and 90, almost double the book value. So you can see that South African banks are just a bit too expensive priced for the variety and the value you can get offshore. But there's nothing wrong with them. They're doing fairly well. In fact, it's quite healthy competition there. And compared to most probably a lot of other South African companies, they're good value. And certainly on the Nedbank fund that I run, we've got quite a high weighting in the South African banks, and I wouldn't sell them. Capitec itself is a brilliant bank. I've known the individuals, in fact, some of them when they were still at Boerland Bank, and from the moment when they started, they've really thought about redesigning the banking space, and they're doing exceptionally well. And because they're small and they're maneuverable, they're actually growing market share off the bigger banks. So it's marginally expensive, but the growth rate in earnings is so fast that it makes up for the earnings or the valuation. But if you come to the last question in terms of the fast lending growth, the only concern is, and there's a lot spoken about that in the press at the moment, is that market can only take so much in loans. And everybody is now, all the big banks are growing in that micro market as well. So the quality of the loans available is deteriorating. So the guys who are coming in last and growing now are taking worse or higher and higher risk, and they deny it, but that is logic. So I think at some stage we're going to get to a problem where they all want still to increase their market share and going to be writing very bad loans. But I don't think we're right there now.
Kokkie, I'll remind Kevin to ask just one question at a time and not three in one go. It's my turn now. And on this unsecured lending issue, earlier we heard the South African Reserve Bank launching an investigation into potential reckless lending in that environment. Do you think there's anything to be concerned about?
The problem is always while the party is on the go and booze is being handed out, there doesn't seem to be a problem. Everybody's happy, and yet the same in the US. If you just think back to the housing bubble there, while house prices were going up and everybody was willing to lend, there were no bad debts. And suddenly, when the cycle stopped and credit was being withdrawn and house prices started falling, we had big problems. So I think the risk more here in South Africa is there's a lot of people who have never had credit before, who are getting credit, and so the risk is that when something goes wrong in the economy, the rand suddenly falls for some reason and interest rates are moved up to protect the value of the rand, and the economy slows down, and then you're going to have the bad debts, because I think there must be a lot of lending happening now which I think is going to prove to not be good lending.